Thanks, everyone. Welcome to the growth stage. My name is Jordan French. I'm a reporter at The Street. We have a very exciting panel today. It comes with a warning, and that is standing up too quickly can make you dizzy. Without further delay, I do want to jump right in and grab our wonderful panelists. First, Julia Austin, professor at Harvard Business School, formerly with Akamai, some exciting stories there, and DigitalOcean. Have a seat. Matt Mickiewicz, who is now with Hired, formerly with and co-founder at Flippa, 99 Designs, and SitePoint. And last but not least, Rene Yang is with us with Vista Equity Partners. Welcome, Rene. Thanks so much for joining us. Folks, let's hop right in. So, scaling too fast. All of you told me right before this panel, it's one of the biggest struggles. Let's start with you, Julia. What are some of your first insights, largely on the product side, that you see and witness that are the problems startups face today?
Yeah, so what I see when a company scales too fast is you're working on your product, you're trying to get product market fit, but you aren't thinking about the long-term scalability process for your product. So how do you make sure it's sustainable? How do you make sure it's secure, performant? You're moving so fast, you're adding resources, you've got cash to burn, but you're not thinking through what is this thing going to look like when you've got lots of user adoption, and how will people operate around managing it going forward?
Certainly, and Matt, on the early stage question, one of your companies you bootstrapped, others you've raised funding for. What's your advice for all the startup co-founders out there on the money question?
Raising money is a very personal decision. I've done it both ways, and both were interesting and unique experiences. One of the key considerations to think about is really how much competition you're going to have in a market and whether additional capital will help you create a better moat and a better defense around your business model. 99 Designs got cloned dozens and dozens of times. My favorite competitor was called 110designs.com. But ultimately, the brand, the customer service, and the systems that we build to serve our customers is what helped us become the #1 in the space.
Great, and Rene, you have a lot of expertise with actually identifying ideal investors. Who should all the co-founders and startup founders be looking for?
When you're at the stage where you're ready to scale, you've probably already found a great product, you know your industry, and you're a domain expert in your actual space. And so what you shouldn't do is find another investor that has similar skill sets. Instead, what you probably don't have is a lot of experience scaling a business. And so as a result, you should find an investor that has experience taking a company from 50 to 500 employees, 5 to 50 million of ARR. If you're not working with an investor that can help you with your sales comp plan, can help you with your pricing, can help you with product management, then what are they good for? And so it's important to really find someone that can complement a lot of the skills that you don't have.
And back to you. So on this question of product, Julia, a lot of startups, they pursue Kickstarter, Indiegogo. Either way, there's a lot of pressure to sell early on. Why should they not?
So why should they not use a Kickstarter, Indiegogo, that type of thing? So I think those can be valuable if you need to prove product market interest and demand, especially if it's a consumer product where you need to validate that with venture to get some early feedback. But it could set you up where you have committed to a delivery date or a certain number of lot sizes that you can't then commit to later, and so you don't deliver on time, which does not look good for your business. And there's a lot of other ways that you can test your product without putting yourself in that position. So I think certain select types of products, it can work, but it's limited. And certainly it can help with venture if you want to prove people are interested, but it's not the end-all, be-all way to do it.
Anything you want to add to this question?
Certainly, there's been a long history of Kickstarter and Indiegogo projects over-promising and under-delivering, not only in the time frame of the actual product, but also in the ultimate feature set that's offered. That's a really bad position to put yourself in on day one of your business, especially when you have a whole bunch of disgruntled customers.
And Matt, while we have you speaking, there are a few differences between how you operated your company, certainly Flippa, 99 Designs, and Hired. You're doing some things differently today at Hired. What are the differentiators?
Yeah, so I had the benefit of more than 10 years of experience at 3 other companies before we launched Hired 6 years ago. And there's 3 specific things that we focused on in the early days. Number one is we were very deliberate about the culture and the values of the company. Every company has its own culture. The question is whether you're deliberate about it or not, whether you're trying to nudge it in one direction or whether it just happens by itself. So we were thinking about this when we were 10, 15 people, very, very early days. Number 2 is we hired our director of HR when we were 35 or 40 people. It's a critical role that too often founders neglect, especially if they don't have experience dealing with HR professionals in the past. HR is important for things like making sure the salary bands across your companies are fair, that the director of marketing in your organization is the same skill level as the director of product engineering, for example. It's important to also protect the company, have employee manuals, think about what your paternity and maternity policies are. All these things are fundamental infrastructure pieces that are key to success as a company scales. And third and finally, we got really, really fucking good at hiring. Hiring is something that people often do in a very ad hoc fashion, but it's important to create a scalable, repeatable process and then teach that process to your managers, to the managers of those managers, so that people have a good experience interviewing with your company, but also that the outcomes and the people that you're hiring at the end of the day are adding true value to your organization.
Yeah, I agree, actually. I think on the team front, it's incredibly important to build a team that really complements each other. Often, founders, when they're starting to look to hire a team, they gravitate to hiring people that are just like them. And instead, as a founder, you should really do some introspection to figure out what are your strengths, what are your weaknesses, and hire for the weaknesses. So if you're a founder that's more product-oriented, focus on hiring people that have strong go-to-market experience, and vice versa. Or if you're a founder that's a visionary, hire someone who can keep their trains running on time. If you're a founder that's more tactical and operational, hire someone that has really great vision and strategy and brand experience. Ultimately, really take the time to figure out your weaknesses and fill those weaknesses as best you possibly can.
And as we're thinking about scale, the other thing I want to add to that is early stage, the people that you hire in the beginning may be just good enough to get what you need done. But then as you scale, oftentimes people don't scale with you, or the role they were in was just fine when you were this big, and when you're this big, they're no longer qualified. The job has sort of outgrown them. And so that can either be great for them if you're going to bring somebody in to help you scale further, and it can be a mentor and somebody they can learn from. But so it's a hard decision, and I'm sure you've seen this before, where somebody just isn't cutting it anymore or isn't happy working at a business at a certain scale than they were when you were in early stage. So that's a difficult thing, but knowing that and being intentional in the beginning when you're planning your organization and when people might be hitting their limits is really important to look for.
Yeah, a mentor once told me that you should expect to turn over 2/3 of your leadership team if things are going really well.
That's right.
And Rene, though, on that question, it can be really difficult, especially early on. You become close friends, comrades with your other co-founders, early employees. How do you handle those situations when it's time to relieve someone if they're not scaling with you?
I think it's all about accountability and alignment. And so if someone isn't able to kind of keep up with the business, really spend time aligning with them what the goals and what the metrics of success are, and lay it out as plainly as possibly can, and hold them accountable to them. If they're not able to do it, you've got to make an objective decision. You've got to be objective with it and not bring emotion into it.
It's incredibly common for the company to scale faster than its people. And as you mentioned, it can be a very difficult conversation to have, but a very critical one at the same time. The people that got you from 0 to 10 are probably not the people that will take you from 10 to 100. It's very different whether you're running a 10-person sales organization that's scaling up to 100 reps, or managing a $1 million marketing budget that's all of a sudden becoming $10 million because of your Series C or Series D fundraising. And keeping the wrong people in seat for too long is incredibly detrimental to the health and growth rate of your company.
And Matt, while we have you again on the issue of personnel, HR used to be, for startups, kind of a backwater. An afterthought. You have a different view on that now. Is that right?
Absolutely. Employees are your most valuable asset. You cannot build a great company without great people. So thinking about the experience that your employees have within the organization, thinking about how to attract the right people to your company, making sure you have a great employer brand, making sure you have a scalable, repeatable process for interviewing and hiring the people that you need for the next growth stage of your business is so, so important. One book that I always recommend to different entrepreneurs that I advise or invest in is a book called The Who. And it's basically a $20 book that you can buy from Amazon, and it lays out a scalable, repeatable process for recruiting and interviewing people, and down to the specific questions you should be asking at each step. That's just a great foundation point to teach your managers and your team to go down the path of becoming great at attracting talent.
Rene, when should a startup hire its first HR personnel?
It's a tough question. I would probably say when you're about 50 employees, you're thinking about an HR leader. Before then, you probably have some type of HR specialist and manager. But when you get to that 50 employee mark, that's when you need to really think about HR as a competency and a strength for the company. Not just in terms of hiring, but onboarding, training, career progression. If you want to continue to grow and scale, you need to be able to do a great job in all of those, not just on the hiring front.
I'd go earlier. I just think we miss it. We miss it too soon, and it doesn't have to be somebody full-time, right? You could have a consultant or somebody work with you, but getting that right in the beginning to allow you to not waste or spend cycles later trying to put that in place or address personnel issues or other things as early-stage companies you just don't have time for, sooner versus later.
HR debt is like technical debt. It just adds up over time. It becomes really expensive and really messy to fix later on. So we hired our director of HR when we were 35 or 40 people, and I think that's probably around the right time to start thinking about that position.
Maybe never too soon in a way. Back to you, Julia.
Sure.
You had a fascinating conversation earlier about a company that you bore witness to in-house, Akamai. So even at bigger companies, they can scale too fast. Tell us that story.
Oh, totally. So Akamai, when I joined Akamai, which is a content delivery system, hopefully you guys know a lot about them. We made the internet, they make the internet faster. When I joined the company, they went from 50 to 250 people just in the 2 weeks from my interview to me joining. We were pre-IPO. We grew up to 1,400 people. It was just crazy time. And nobody was really thinking about process, organization structure, and we were pretty much running the internet back then. I mean, most of the large properties, CNN, Microsoft, et cetera, were running on our platform. So we were very rogue with engineering. They're really smart engineers, MIT, brilliant people, but they also had complete access to the system. So we had a situation where an engineer, well-intended, just got into root, because everyone had root access, if you know what that means, and made a change, a well-intended change to make the system better, fix a bug. And we brought the entire platform down, which meant brought all our customers down. And that was a disaster, and it was a real wake-up call for us as a business, and we'd grown so fast, and we hadn't really put the right procedures and processes in place that we literally compromised all of our customers to the point where they were denying service to all of their customers. And the next day we had fixed it, but that actually wasn't true. We had another bug that we didn't identify that then resulted in people getting the wrong content. So imagine clicking on CNN.com and getting Playboy.com content. That's what was happening. And it was, again, one of those moments where we said, wow, we're so great, we're so successful, we grew so big that we didn't think about the right processes that would allow us to still be nimble and move fast, which we needed to do, but be smart and not compromise our business. And we waited too long to put those processes in place.
Yeah, coming from an investor's perspective, I think having processes and infrastructure is crucial to being able to scale. Often companies think of growth at all costs instead of really building that infrastructure. I'm a big believer in this saying, you have to go slow to go fast, which means you need to take the time to actually invest and put in the right conditions for your company to be successful. So figure out product market fit before you start pouring gas on the fire. Figure out the most cost-effective customer acquisition channels, whether that's inside sales, lead gen, channel partner strategy, field deployed sales reps. Figure that out and test all of those out before you actually start pouring gas on the wrong fire, because that's what is ultimately going to cripple the company.
Thanks for that, Rene. Back to you, Matt. You've had a wealth of experience. A lot of folks in the audience already know the companies that you've worked with. It also means that you've had a lot of opportunities to fail, and maybe even epically too. You can't teach people necessarily success at scaling, but what are 3 things that we can all take away from this talk that can guarantee failure and that everyone certainly wants to avoid?
Yeah, so 3 things to think about as you're scaling up your company. Number 1 is have a really good finance function. So at one of my earlier businesses, we weren't keeping a good eye on the collectible debt. We had salespeople making deals that were only getting partially fulfilled. We were issuing invoices that were wrong or that we would be unable to collect. And it really hit us in the face in a big, big way. So making sure you're keeping track of your days sales outstanding, making sure your collection cycle is efficient, super, super important. Because we had a big failure there that cost us hundreds of thousands of dollars. Number 2 is cap table. Cap table management, especially if you have investors, advisors, and hundreds of employees, becomes really complex. I used to just rely on lawyers and would assume they were doing the right thing and keeping track of who had what options and who had what shares, but they are not infallible. And if they make a mistake that you catch months or years later, it can cost you a lot of money to correct that. So using something like Carta, which was previously eShares, is one way of solving that problem. And the third thing to think about really is the unit economics of the business. Fundamentally understand how much it costs you to serve one additional unit, to sell one additional software license or SaaS subscriptions, and all the costs involved. And then think about ways of optimizing that through low-cost labor centers, through more efficient marketing, through better trained salespeople as well. So employee onboarding, which is something we touched on earlier, is so, so critical. If you can onboard your salespeople and have them hitting their quota within 90 days rather than 6 months, that fundamentally changes how fast your company will be able to grow. So investing in onboarding and training internally is key as well.
And Julia?
I think that one thing I'd add to that, those are all 3 great ones, is make decisions about employees faster than you want to. It's the most painful thing you have to do as a leader is when you have somebody who's just not a fit for the business, or even a hiring decision. You can't hold out too long if you need to hire fast. But when you hire the wrong person, you know it's the wrong person or they're just not working out anymore, make the decision. You will spend more cycles with anguish over that decision than what it will take to get it done, and I promise you will feel a whole heck of a lot better once you do it.
Rene, I'll give you the last word.
And I've got 2. First is never assume you know the answers to everything. It's always going to take you twice as long, cost you 3 times as much to get to a quarter of where you thought you would be. And so really lean on others around you, whether that's investors, advisors, team, to get to, so that you're not reinventing the wheel, you're not making the same mistakes that your predecessors have. The second is use data to make your decision. Be metrics driven and rely on data rather than on gut and emotion.
Well, thanks, everyone. That wraps up our panel. Rene Yang, Julia Austin, Matt Mickiewicz. See you next time.